The show is part of OnePlace, a daily network of focused briefings across the stories people follow most.
Welcome to our daily roundup. We have a packed schedule today covering everything from massive corporate buyouts to the shifting landscape of global conflict and the future of autonomous transportation. Let's dive in.
GameStop's CEO proposes a massive $56 billion eBay buyout.
Magnus Steel and Infrastock delivers incredible multi-bagger returns.
Spirit Airlines workers face a chaotic and sudden shutdown.
The airline nearly finishes refunding customers after its collapse.
UK food prices are projected to rise 50%.
Trump reviews a 14-point peace proposal from Iran.
Restaurants embrace never-ending limited-time offers to drive sales.
Venture capital pours billions into a few self-driving leaders.
First, the GameStop news. GameStop CEO Ryan Cohen has certainly made waves with his unsolicited $56 billion offer to acquire eBay. This is a bold move considering GameStop's market cap sits around $11 billion, while eBay is valued at $46 billion. Cohen told the Wall Street Journal that he believes eBay should be worth hundreds of billions and wants to transform it into a legitimate competitor to Amazon. The proposal includes a price of $125 per share, split evenly between stock and cash. Cohen has already built a 5% stake in eBay and is prepared to take the offer directly to shareholders if the board isn't receptive. It is a massive gamble for a company that has been struggling with store closures as the gaming industry shifts toward digital downloads and streaming services.
The internet's reaction was swift and predictably filled with memes. Many are questioning how a company known for physical retail and meme stock volatility can swallow a giant like eBay. However, Cohen's track record with Chewy and his 2023 appointment as CEO suggest he is serious about a total pivot. If this deal were to go through, it would mark one of the most surprising corporate revivals in history. By acquiring eBay, GameStop would instantly gain a massive e-commerce infrastructure and a global user base, moving far beyond its brick-and-mortar roots. While eBay has not yet officially responded to the request for comment, the market is watching closely to see if this is a genuine strategic shift or just another high-profile moment in the ongoing saga of retail investor enthusiasm and corporate ambition.
Next, a penny stock success. In the world of investing, Magnus Steel and Infra has become a standout example of a multi-bagger penny stock. Just 4 years ago, the share price was a mere 2 rupees and 77 paise. Today, it is trading at over 151 rupees on the BSE. This represents a staggering transformation where an initial investment of 1 lakh rupees would now be worth approximately 55 lakh rupees. The stock has consistently outperformed even during periods of weak market sentiment, delivering over 800% returns in just the last 6 months. This kind of growth is rare and highlights how thorough research and patience can pay off, especially when a company shows significant operational improvement. The company's revenue for the last fiscal year climbed to over 22 crore, nearly 6 times higher than the previous year.
The financial data backs up this meteoric rise. Magnus Steel reported a net profit of 4.5 crore for fiscal year 26, which is a massive jump from the 5.67 lakh reported in fiscal year 25. Managing Director Chinmay Pradhan attributed this success to disciplined execution and strong business momentum. The company also recently completed a 45 crore preferential raise, which provides the capital needed to scale operations further. While penny stocks are often seen as high risk, the sustained growth over 3 years, totaling over 6,000%, suggests a fundamental shift in the company's value proposition. Investors who held through the volatility have seen life-changing returns. It serves as a reminder that while the broader market might be struggling with geopolitical tensions, individual companies with strong execution can still deliver exceptional value to their stakeholders.
Now to Spirit Airlines. The sudden collapse of Spirit Airlines has left 17,000 employees in a state of shock and heartbreak. The airline officially ceased operations at 3 a.m. on Saturday after 34 years in the sky. Many workers, like flight attendant Yaneshia Thomas, found out through union emails or social media rather than direct company communication. Thomas described the experience as feeling like being in a relationship where you find out your partner is cheating through the internet. The situation was so abrupt that some employees were told by TSA agents to remove their uniforms because they were no longer authorized to wear them. This shutdown followed a desperate but failed attempt to secure a $500 million federal bailout. For many who had already endured furloughs and pay cuts, this final blow was a devastating end to their careers. At the budget carrier,
The signs of trouble were there, but the speed of the final wind down caught everyone off guard. Routine flights were being canceled as early as Friday, yet many staff members held on to hope that a deal would be reached. Spirit had been struggling for years, facing 2 bankruptcies and a blocked merger with JetBlue. The final straw appears to have been the skyrocketing cost of jet fuel, driven by the ongoing conflict between the U.S., Israel, and Iran. As the airline enters orderly liquidation, the human cost is becoming clear. Employees who were on the road when the news broke had to find their own way home on other airlines. While the union is trying to assist with the transition, the sense of betrayal among the workforce is palpable. They were putting in the work, but the financial pressures simply became insurmountable.
regarding customer refunds, as Spirit Airlines winds down, the company reports it has nearly finished refunding customers for the thousands of flights canceled over the weekend. The airline had about 4,000 flights scheduled through mid-May, leaving many travelers stranded. Transportation Secretary Sean Duffy has been vocal about the situation, advising customers not to even show up at the airport, as there is no staff left to assist them. Duffy blamed the Biden administration for the collapse, arguing that blocking the JetBlue merger was a disaster that reduced competition and led to this failure. He suggested that allowing the merger would have protected travelers and pricing. The airline itself stated that the sharp rise in oil prices due to the war on Iran was the final death blow, as no additional funding was available to keep the business afloat during such extreme market volatility.
The political fallout from the collapse is intensifying. Senator Elizabeth Warren defended the decision to block the merger, noting that a judge appointed by Ronald Reagan ruled the deal illegal because it would have led to fewer flights and higher fares. She pointed to spiking oil prices as the primary cause of Spirit's demise, accusing Republicans of trying to shift the blame away from external economic pressures. Regardless of the political debate, the reality for travelers is a significantly diminished, low-cost carrier market. Spirit had not turned a profit since 2019, and its liquidation marks the end of an era for budget travel in the United States. The focus now shifts to how other airlines will absorb the remaining demand, and whether the loss of Spirit will lead to the very price hikes that regulators were trying to avoid.
Next, UK food prices. A grim milestone is approaching for UK households, with food prices on track to be 50% higher by November compared to mid-2021. Research from the Energy and Climate Intelligence Unit suggests that the price growth usually seen over 20 years has been compressed into just 5. This quadrupling of the pace of food inflation is driven by a perfect storm of extreme weather, global supply chain disruptions, and volatile energy markets. Staples like pasta, eggs, and beef have already seen increases of up to 64%, while olive oil has surged by over 100%. These items are particularly sensitive to the costs of synthetic fertilizers and the energy required for production and transport. The average household food bill rose by over £600 across 2022 and 2023, with energy shocks accounting for a significant portion of that increase.
The outlook remains challenging as climate change continues to impact harvests. Analysts point out that 3 of England's worst harvests on record have occurred in the last 5 years. Specific climate-impacted foods like butter, milk, and coffee are seeing prices rise 4 times faster than other products. There is a strong call for a shift toward net zero emissions to stabilize the food system and reduce reliance on volatile oil and gas markets. Without these changes, experts warn that food prices will continue to spiral, leaving many families under prolonged financial strain. The current crisis isn't just a temporary spike, but a reflection of deeper systemic vulnerabilities. As 2027 is predicted to be one of the hottest years on record, the pressure on global agriculture is only expected to intensify, making food security a top priority for policymakers and consumers alike.
Now, the Iran conflict. Iran has submitted a 14-point proposal to end the war with the United States, which President Trump is currently reviewing. The proposal includes demands for non-aggression guarantees, the withdrawal of U.S. forces from areas surrounding Iran, and the lifting of naval blockades. Tehran is also seeking the release of frozen assets and compensation for damages. However, Trump expressed skepticism on social media, stating he doubts the plan will be acceptable because he believes Iran hasn't paid a high enough price for its actions over the last few decades. Despite the tension, Trump announced a humanitarian mission to guide neutral ships trapped in the Strait of Hormuz starting Monday. This move comes as oil prices have surged following the start of hostilities in February, with the closure of the strait cutting off 20% of the world's oil supply.
The economic stakes of this conflict are massive. Financial analysts are warning of a second wave of inflation that could hit households hard. While the impact at the gas pump is immediate, the real hit will come from the increased costs of everyday products that rely on stable energy prices. Investment firms are outlining grim scenarios if a peace deal isn't reached soon, as the war enters its second month. Iran's insistence that the issues be resolved within 30 days adds a sense of urgency to the negotiations. The focus is shifting from a simple ceasefire to a total end to the war on all fronts, including Lebanon. As the U.S. begins its mission to clear the Strait of Hormuz, the world is watching to see if this leads to a de-escalation or further confrontation in one of the world's most vital waterways.
Moving to restaurant trends, the restaurant industry is leaning heavily into the urgency economy, with a strategy of never-ending limited-time offers. What used to be a seasonal treat, like the McRib, has become a permanent fixture of menu innovation. Chains like Chipotle are doubling down on this approach, finding that protein-based promotions consistently drive higher transactions. The goal is to keep the brand top of mind in a fractured attention economy where consumers are constantly bombarded with choices. By creating a sense of scarcity, restaurants encourage diners to act quickly. Interestingly, executives have noted that the gains from these promotions often persist even after the offer expires, as new customers are drawn in and become regulars. It is a lower-risk way to innovate compared to a full menu overhaul, allowing brands to test new flavors and keep their offerings feeling fresh and exciting for a modern audience.
However, there is a potential downside to this constant stream of promotions. Experts warn that endless limited-time offers risk training customers to only engage with a brand when there is a deal or a novelty item available. This could erode long-term brand loyalty if the core menu isn't strong enough to stand on its own. As promotions become more hyper-personalized through digital apps, the competition for consumer attention is only getting fiercer. The strategy reflects a shift in society toward instantaneous gratification and a constant desire for something new. While it drives short-term sales spikes, the challenge for operators is to balance this novelty with sustainable growth. For now, the steady drumbeat of new sauces and returning favorites seems to be the winning formula for keeping dining rooms full and digital orders flowing in an increasingly crowded marketplace.
Finally, autonomous vehicle funding. The autonomous vehicle sector is seeing a massive influx of venture capital, but the money is being concentrated in fewer hands. So far in 2026, the industry has seen nearly $19 billion in funding, the highest in over a decade. However, the vast majority of that, $16 billion, went to Alphabet's Waymo alone. This concentration suggests a maturing industry where investors are no longer spreading small bets across many startups, but are instead backing the clear leaders. Other significant players include the UK-based Wave and the autonomous trucking firm Waabi. This shift reflects a more disciplined approach from investors who learned from previous hype cycles that chasing similar milestones across dozens of companies carries too much risk. The focus has moved toward vertically integrated operators and platforms that can actually turn self-driving technology into a viable, scalable service.
This consolidation of capital highlights the immense challenges that remain, including regulatory hurdles and the sheer cost of operationalizing autonomy. Uber is also positioning itself as a major aggregator, forming partnerships with companies like Zoox and Rivian to ensure it remains a central player in the robotaxi market. While the total number of deals has dropped significantly since the peak in 2021, the dollar amounts are much higher for the winners. This suggests that the industry is entering a phase of execution rather than just experimentation. The massive funding for Waymo and a few others indicates a strong confidence that the self-driving future is finally within reach, even if it belongs to a very small club of well-funded giants. As the technology moves closer to widespread public use, the focus will likely stay on these few dominant players who have the resources to cross the finish line.
That wraps up our briefing for today. Thank you for joining us for this daily roundup. Be sure to follow the show for your next update tomorrow morning.